Alright, so the next problem we'll work through is problem 2-1A. What we're given is a list of transactions, and part 1 is to record these transactions into the T accounts, and then part 2 is to determine the account balances of those T accounts. And we can do those two simultaneously. So if we want to start, we can start with our cash T chart. If we draw out all of our T charts first, might be easiest. So we'll do cash first. Make sure you leave yourself enough room for the cash one since that one has the most transactions. Next one we have is accounts receivable, and then we have supplies. If we keep going, we've got prepaid insurance, and we've got automobiles, and we've got equipment. So what all of these have in common is that all of these are assets, including the equipment. Just fix that a little bit. Okay, so these are all assets. Alright, so then we've got some more. We've got notes payable. We've got accounts payable. We have common stock. Professional fees. We're going to need to add in a paper here. Okay, so professional fees, and then we have salaries, expense, we have blueprint expense, we have rent expense, we have auto expense, and then we have miscellaneous expense. Okay, so if we scroll back up here to our first transaction, it tells us we issued common stock in exchange for $30,000. So that tells me that for transaction A, I received $30,000 of cash. I know to put it on the debit side because I'm increasing my cash, which is an asset, and I increase assets by debiting in exchange for $30,000 of common stock. We know we increase common stock by crediting, so we'll credit our common stock for transaction A. Alright, transaction B tells me I paid January rent for the office and the workroom of $2,500. So if I paid it, that means I saw $2,500 coming out of my cash. And it was for rent, so I need to find my rent expense and debit it for $2,500. Remember, expenses have a normal balance of debit because they ultimately decrease stockholders' equity. transaction C tells me I purchased used automobile for $28,500. I paid $6,000 in cash, and then I gave a note payable for the remainder. So I received an automobile, which is an asset, valued at $28,500. I paid $6,000 in cash, so I'm going to credit cash for $6,000. And then the remaining balance, I issued a note payable, so I'll put the $22,500 credit to note payable. It's a liability. I'm going to owe somebody an additional $22,500. I increase liabilities by crediting. Okay, transaction D. I purchased office and computer equipment on account for $8,000. So I want to find my equipment T-chart. I received equipment of $8,000, increasing an asset by debiting, and instead of paying cash for it, I put it on account. So I'm going to go down here to my account payable and put the $8,000 there. Okay, transaction E. I paid cash for supplies of $2,100. So I received supplies for $2,100. So I increased my asset of supplies. In exchange, I paid cash. So I decreased my cash by that $2,100. Okay, transaction F. I paid cash for annual insurance policies of $3,600. So it's an annual policy, so that means it's going to last for the whole year. I'm not going to use it all up right away, so it's going to be an asset. I paid for it up front, so I'm going to increase my prepaid insurance, $3,600, and I paid cash for it, so I'm going to decrease my cash by $3,600. Okay, transaction G. I received cash from a client for plans delivered of $9,000. So this time, instead of paying out cash, I'm receiving cash. So I'm going to put transaction G as a debit to cash. I'm receiving cash. I'm increasing my cash balance. And it's for plans delivered. So if I find my professional fees account, I'm going to credit it. This one is acting as our revenue. Okay, transaction H. I paid cash for miscellaneous expenses. So if I find my miscellaneous expenses, I'm increasing the expense. I'm debiting. I paid cash for it. So I'm decreasing my cash for transaction H. So I'm crediting it. Okay, transaction I. I paid cash to creditors on account. So if I'm paying it off, that means I'm going to decrease my cash amount. Okay, and then the offsetting debit is going to be my accounts payable. I'm decreasing the liability. I get to decrease the liability because I no longer owe it, because I also decrease the asset by paying out cash. Okay, transaction J. I paid installment due on note payable of $108,075. So I paid it out. So once again, that's going to be a decrease in my cash. Instead of this time it being an account payable, it's going to be on the note payable because they tell me it's the installment due. So I'm going to decrease my note payable by $1,875. Almost done. Transaction K. I received an invoice for blueprint service due in February of $5,500. Okay, so that tells me I'm going to owe this amount, so it's going to be a payable. I'm going to increase my account payable, which is a liability, by crediting it. And then the offset is going to be an expense. So it's going to be my blueprint expense. Okay, transaction L. I recorded fees earned on plans delivered. Payment is to be received in February of $31,400. Okay, so I haven't received it yet. I normally would receive cash, but they didn't pay for it right away. So instead of recording a cash payment, I'm going to record a receivable. So because they didn't pay me yet, it's still receivable. So I'm going to increase that asset. Instead of increasing my cash asset, I'm increasing my accounts receivable asset. And why am I getting that money? Because I performed a service, so I'm receiving revenue of $31,400. Okay, transaction M. I paid salary of assistants for $6,000. So if I paid it out, that means it's going to be a decrease to my cash. I'm running out of room. So I have M over here for $6,000. I paid it out for salary of my assistants. So it's going to be a salary expense of $6,000. We increase expenses by debiting. And then my last transaction in, I paid gas, oil, and repairs on automobiles for $1,300. So once again, I paid it out, so I need to decrease my cash for $1,300. And it's an expense. It's going to be my auto expense of $1,300. Alright, so that takes care of part 1. Part 2 says determine the account balances of the T accounts. So if I scroll up here and start with my cash balance, one that has the most stuff going on, in order to determine the ending balances, I need to add my debits and subtract all of my credits. So I would have 30,000 plus 9,000 minus 2,500 minus 6,000 minus 2,100 minus 3,600 minus 2,600 minus 4,000 minus 1,875 minus 6,000 and minus 1,300. And if I do all of that, my debits are going to be larger than my credits, and I end up with a balance of $9,025. That makes sense. Cash is an asset, a normal asset balance is debit. So if I came up with a credit balance, I would want to get to checking things. Alright, accounts receivable is easy. We only have the one thing going on, so my end balance is going to be a debit of $31,400. Same thing with supplies and prepaid insurance and my auto. I only have my one debit. Equipment, I only have my one debit. Okay, so if I come down here to notes payable, I have two things happening. I have a credit of $22,500 and a debit of $1,875,000. So if we do a common sense check here, we can see that my credit is bigger than my debit. So my ending balance is going to be a credit. So I would do $22,500 minus the $1,875 to end up with a credit balance of $20,625. Once again, that makes sense. A note payable is a liability. A normal liability balance is a credit. Okay, if I come to my accounts payable, I would do 8,000 plus 5,500 minus 4,000, and I would end up with a credit balance of 9,500. Common stock, I only have my one credit of $30,000. Professional fees, I add up my two credits to come up with a balance of $40,400. Salaries expense, I only have my one debit. Blueprint expense, I only have my one debit of $5,500. Rent expense is $2,500. And then auto expense, one debit of $1,300. Miscellaneous expense, one debit of $2,600. Okay, so if we want to do a quick check here, if I add up the balances of all my asset accounts, so 9,025 plus 31,400 plus 2,100 plus 3,600 plus 28,500 plus 8,000, I get a total balance of $82,625. The rest of these accounts are my liabilities and my stockholders' equity accounts. So if I add these up, now we have to be a little bit careful here because we have some with the normal balance of debit and some with credit. So I would do 20,625 plus 9,500 plus 30,000 plus 40,400. They're all on the credit side. And then I would need to subtract my debit balances. So I'd do minus 6,000, minus 5,500, minus 2,500, minus 1,300, and then minus 2,600. So if I do my assets plus my liabilities plus my stockholders' equity, I get the same 82,625. And this makes sense because we know assets has to equal liabilities plus stockholders' equity. So for both of them, I got the $82,625. Okay, so if we move on to the next part, we want to prepare an unadjusted trial balance for the architect company as of January 31st, 2018. To do this, all that you need to do is take all of your balances from your T-charts that we just did. Nothing else. So we're just pretty much copying and pasting here. So my end cash balance was $9,025. My accounts receivable was $31,400. My supplies were $2,100. My prepaid insurance was $3,600. My automobiles were $28,500. And then my equipment was $8,000. All of those together are my assets. Next little group, my notes payable and my accounts payable are going to be my liabilities. And then after that, we have everything that will affect our stockholders' equity. So that's good. All of our assets have normal balances of debit, and then my liabilities. I have a note payable with a credit balance of $20,625. Accounts payable with a credit balance of $9,500. And that's good. Both of those are credit balances, which is the normal balance for liabilities. Okay, moving on to my stockholders' equity. Common stock, I have a credit balance of $30,000, which makes sense because common stock increases stockholders' equity. We increase stockholders' equity by crediting. Professional fees, in this case, is like my revenue. Revenue increases stockholders' equity, so it should have a credit balance, which it does. Okay, salary expense decreases stockholders' equity, so we should have a debit balance, which we do, of $6,000. Blueprint expense has a debit of $5,500. Rent expense has a debit of $2,500. Automobile expense of $1,300. And miscellaneous expense of $2,600. So we all have our normal balances, which is good. So if we add up our debit column, we get a total of $100,525. And if we add up our credit column, we'll get a balance of $100,525. So we see that debits equals credits. So in the first and second part, we proved that assets equal liabilities plus stockholders' equity. In this part, we proved that debits equal credits. Always, always, always. Okay, so for the last part of this very long problem, we want to determine the net income or net loss for January. So in order to do that, we start with our sales revenue. And in this case, they called it professional fees. And the total we had was $40,400. Okay, and then on our income statement, we do revenue, and then we do minus expenses. And the expenses that we had this time, we had salary expense, we had blueprint expense, we had rent expense, we had auto expense, and then we had miscellaneous. So if I go to my trial balance and pull all those numbers over, So take out salary of $6,000, blueprint of $5,500, rent of $2,500, auto of $1,300, and miscellaneous of $2,600. We would come up with a net operating income of $22,500.